Welcome back. Here's another look at markets in the early trade today. The story really remains here at home in Toronto with the S&P TSX Composite Index breaking through 25,800 points. Let's talk about all of this with an expert. He's Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, ScotiaMcLeod. He's going to be our guest host for the next hour. Thanks a lot for coming in, first of all. It's
Great to be here, Paul.
Good
morning.
Yeah. How should investors be thinking about these markets, which are just, it's difficult to remember a couple of years like we've had this year, and they're not showing any signs of easing up as we get into the last portion of the year?
It really feels really good, which kind of reminds me a little bit of the 90s period, right? And where markets were just so great and everybody was so excited. Of course, that didn't end so well. So we got to ask ourselves, where are we? Are we in 1996? Are we in 1997, 98, 99? And I do think that investors want to look at what we have in front of us right now as in two parts. First of all, look for the end of the year. Between now and the end of the year, which way the market's going to go, markets are going to continue to stay strong. You've got, a live Fed meeting where the Fed is probably going to reduce 85 percentage points, 85% that they're going to reduce. Central Bank, of Canada, we're going to be reducing as well. You've got seasonality, you've got consumers that are very strong, you've got all these great themes. So for now to the end of the year, performance chase markets are going to do just fine. What's going to have to happen after that? I think it's the next place that people really want to start looking. And of course, there's so many positives. But there also is this inflation uncertainty, which is exacerbated by which way tariffs are going to go. So if they get it wrong with their tariffs against the BRIC countries at 100% or against Canada and Mexico at 25%, that could really cause prices to go up. Maybe we want to be taking Donald Trump at face value here. Maybe he's not just, this is not just bluster. So this is the concern, and this could be the fly in the ointment. And when you combine that with valuations which aren't cheap for much of the S&P 500, it could be that markets don't go straight up.
What kind of questions do you take from clients in a market like this? Are some of them a bit worried about their equity market exposure at these levels?
Some people. There's people that, there's plenty of articles from some well-known bears that say be careful, say that you want to be more cash. And, certainly when you have had the S&P 500, which is up 30%, taking a little bit of money off the table here, having a discipline, having some sort of asset allocation, does make sense for sure. So, if you do want to be in cash, yes, it's paying a lot less in Canada, still paying pretty good in the United States. But there's nothing wrong with if you have a 70-30 asset allocation. I'm still pretty long into the end of the year, so I would be around 75, 76 on a model like that. Plenty of ammunition to score points, but to have 25% held back in cash or bonds or coupon bonds, that's just prudent.
How difficult is it to find attractively valued stocks in a market like this? And that's your job.
Yeah. Well, first of all, it's not that bad. Markets are always most difficult. At the time, looking back, they're always easy. You say the easy money's already been made. Let's start with the 493 stocks of the S&P 500 that aren't the Mag 7. There's a lot of value in there. There's a lot of value in the Russell. If you look at the Canadian financials, they're pretty cheap and probably turn the corner here. The U.S. financials are still very soberly traded. Then you got all these tax loss selling names that have really been, come down, probably pressed down a lot more than they should, like BCE, like Rogers, that are at least going to get a tax loss selling pop into January. So all things being equal, names like that, names like Nutrien, names like in the U.S., Pfizer, Boeing, Intel, maybe some of the less popular names in Canada that are the smaller caps like Auto Canada, Superior Propane, Varen, that have been pressed down here, that all things being equal are likely going to have a pop at least into January. So, some of those are trades and some of those are longer term.
Right.
But I think that still plenty of opportunity here.
BCE is the parent of this television network through its Bell Media division. How should investors think about tax loss selling? Should they pull the sell, push the sell button on a stock they're down on?
Well, you know, it's different for everybody, but you know, we are looking this time of year at what are the gains that people are paying, and what we want to do for every account is have it march from the lower left to the upper right, have those accounts go up in value, and have people pay as little taxes as possible. So, to the extent that they've had gains year to date, yeah, it does make sense to maybe, even though we like BCE at $37, it's okay that maybe you sell that for a loss and move that into TELUS, because we also like TELUS down here, and it's down for similar reasons. So, yeah, I do think it makes sense, but you do have to understand that in a time like this, where almost everything's up, it's very hard to find things that are down. So those things that are down are getting pressed down even more because people just want to get them off the sheets for now to take that loss. So, all things being equal, that does create an opportunity to buy those, at least for a trade.